US bond yields are down after Fed Chair Jerome Powell appeared to rule out rate hikes. The Bank of Japan may have intervened again, South Korean and Indonesian inflation has eased, and Australia's record imports suggest demand might be holding up. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ agricultural economist Susan Kilsby looks at how global economic developments and the weather are affecting demand for New Zealand's key primary exports.
One factor that is helping the dairy industry out is that global milk production is reasonably subdued. It's pretty stable here in New Zealand this year relative to last year.
But first, in 5 and 5 with ANZ, bond markets and stock markets heaved a sigh of relief overnight after Fed Chair Jerome Powell ruled out rate hikes, which some had begun to fear. Here he is in yesterday's news conference after the FOMC held the Fed funds rate as expected.
So I think it's unlikely that the next policy rate move will be a hike. I'd say it's unlikely. Our policy focus is really what I just mentioned, which is how long to keep policy restrictive.
Bond markets rallied after those comments, especially for shorter-term bonds. The 2-year Treasury yield fell 5 basis points overnight to 4.88%. The 10-year was down 2 points to 4.57% by 5 a.m. Sydney-Melbourne time. US stocks up almost 1%. The US dollar fell in tune with those lower US yields. That meant the Aussie and Kiwi dollars were up about 0.5% against the US dollar to 65.62 US cents for the Aussie and 59.55 US cents for the Kiwi. Here's ANZ Head of FX Research, Marja Bin-Zaman.
Maybe the market taking some relief from Chair Powell's remarks that the next move in rates is unlikely to be a hike. And, when we look at positioning, markets were positioned very hawkish going into the meeting. So we have seen a little bit of an unwind of that today with the dollar just marginally weaker and, of course, the Aussie and Kiwi trading positive.
Number 2, there's speculation the Bank of Japan intervened again yesterday after the US Federal Reserve's decision. Dollar yen was trading this morning at 153.5 yen. It fell sharply yesterday from 157 to nearly 153 at one point, fueling that speculation. Meanwhile, Marja Bin says the Bank of Japan's minutes out yesterday for its March meeting were dovish, if backward-looking.
They said that the rate hikes will likely not be rapid. This is not a shift to a tightening cycle, and financial conditions are expected to remain easy.
Number 3, South Korea's CPI inflation rate eased slightly more than expected in April, with the annual rate at 2.9%. ANZ economist Crystal Tan says if this continues, the Bank of Korea looks on course to be able to cut rates from the third quarter of this year.
The main uncertainty is on the supply side. So going forward, the pace of further slowdowns in inflation is going to depend on oil and agricultural product prices, as Korea is a net energy and food importer. But for now, if global commodity prices stay around current levels, we do think headline inflation is on course to converge towards the Bank of Korea 2% target by year-end.
Crystal also reports Indonesia's CPI inflation rate was lower at 3% annually and well within the central bank's 1.5% to 3.5% target band. Number 4. Meanwhile, tonight, the focus is on US non-farm payrolls data. ANZ's head of G3 Economics, Brian Martin, expects monthly growth of around about 240,000 jobs, but he's also looking at one other bit of data for an inflationary pulse the Fed might worry about.
I think it'll be equally important, if not more important, to watch what's going on in wages. They're expected to ease slightly to 4% year on year from 4.1% year on year. And our assessment of the mix of US employment growth at the moment, which is chiefly concentrated in part-time jobs, fits with the view that labour wage growth is going to moderate further in coming months.
Number 5. Australia's goods trade surplus came in lower than expected at $5 billion Australian dollars in March, its weakest level since November 2020. ANZ economist Maddie Dunk says record high imports during the month were the driver, and this tells its own story about demand in the Australian economy.
It suggests that there's still demand out there if we're still going out and buying things. I think particularly if you look at categories like consumable goods, which are up and are quite strong, suggests that there's still demand out there. Now, when you talk to retailers, you are hearing that they're cutting back on terms of bringing stock in and they're trying to lower their inventories, but the trade data maybe suggests otherwise.
Maddie Dunk there. Now, in today's bonus deep dive interview, ANZ agricultural economist Susan Kilsby says the weather has meant the outlook for New Zealand's primary sector is high and dry, and that soft consumer confidence in China is also having an effect.
Yeah, so it's made it pretty tough for farmers, particularly sheep farmers through the autumn, because there hasn't been a lot of green feed available, and that's what we need for our lambs. So, and it does mean a lot of the winter feed has also been already chewed up in some of those areas. There has been some rain now, so things are starting to improve, but it's certainly just going to keep feed in those regions pretty tight through the winter period.
Any flow through to prices just from those weather effects?
I mean, it certainly made it much harder to get lambs fattened. So we've had lambs on farm longer than normal. And that's, just adds to the cost of production. We're certainly in a season where costs of production of lamb are higher than the returns anyway. So it's making, it's just adding to the cost and the deficit that our sheep farmers are facing this season.
So what are you seeing from domestic demand in China?
So we're sort of seeing demand for most of the products we export to China is reasonably soft. And, China is now our biggest market for a lot of our export products. So that's certainly having an impact on pricing. I mean, what's really happening there is that consumers just don't have the confidence that they had a few years ago. So they're sort of erring away from higher priced goods. So that's really impacting protein markets, particularly lamb, which is a high priced protein. And we do sell about half of our lamb product into that market, and virtually all of our mutton goes into that market. So that's really impacted pricing for those goods, and it looks like it could remain that way for a wee while yet as well.
And just looking at that milk price, it's obviously important for New Zealand's economy. What are the risks for the milk price, especially with that China demand?
Yeah, so China is the largest importer of dairy products by a long way. They import about the same amount as the next 7 or 8 countries put together. So what China's doing does really impact the global dairy industry. So we've got sort of slightly softer demand coming from that market. They are still importing reasonable volumes, but the demand is not strong enough to sort of push prices up a whole lot at this stage. One factor that is helping the dairy industry out is that global milk production is reasonably subdued. It's pretty stable here in New Zealand this year relative to last year. And we're seeing sort of similar trends in the other big dairy exporting nations like the EU and the US. So that's sort of helping balance out this weaker demand, so that we are starting to see prices creep up a little bit. So our outlook for next season is a little bit stronger than the current season. So our current season's milk price forecast is $7.85, and we're expecting it will get to $8.50 for the 2024-25 season.
Now, there's been some good news from the United States. How's that flowing through into prices?
Yeah, so we sell a lot of beef into that market. We also sell a lot of our higher lamb cuts. It's a big market for French racks, and they've been doing really well. We're seeing really good demand from that market for that particular lamb cut, but it's not enough to offset the weaker demand we're seeing from China for the other parts of the lamb. And what we are also seeing in the US market is really strong demand for beef. Their own domestic beef kill has been elevated, and there's been a lot of beef going into that market from a number of countries, but yet it's all still being consumed. And I think some of that, it relates to the fact that a lot of our beef is used in the likes of hamburgers. So, people may be trading down a little bit, but there's still that underlying demand for products like hamburgers is still really strong. And we're expecting to see some upside in beef prices next season, as there will be less beef available in the US domestic market, and that's likely to flow through to stronger prices despite demand from China, which is our other sort of big market for beef, being just a little bit more subdued than usual.
Susan Kilsby there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, May the 3rd. Catch you next week with a 2-part look at what might happen to US-China relations if Donald Trump is re-elected. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.